when was the last time you talking about doing the minimum to get to where you wanted to go was the right decision, right? I would argue with you that it's not about doing the minimum. It's a matter of like figuring out where do you want to go, what do you need to do to get there, and how can you make that happen, right? So, hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I want to talk to you about the top 10 frequently asked questions that I get in regards to infinite banking. Now, I'm going to be real with you. This is going to be tough for me because I could probably do a 10 to 15 minute video on each one of these questions. I'm going to do my best to keep it really tight. Some will be longer than others, but let's get into this. So the first most common question that I get is, what if I'm uninsurable? This happens a lot of times. Unfortunately, sadly, the people who want to take advantage of this are not able to get insurance. Maybe you're in a position where you've had diabetes, maybe you've had a heart attack, you have some kind of health ailment. There are always opportunities to, if you have a business partner, if you have a kid, there are opportunities to find other people that you have insurable interest on that you can take insurance out on. Now, here's the biggest thing. You want to make sure whoever that you get insurance for, that you have a really, really deep insurable interest on them, because you're not going to be able to go to the insurance company and just write insurance on anybody, right? Like, you have to show insurable interest. And furthermore, what I'd say is you don't want to write insurance on somebody that you don't have insurable interest on, because listen, here's the biggest thing. Remember, if you understood the death claim process on a life insurance policy, you have to get the death certificate, right? So if for some reason, yes, you're not writing this for the life insurance side of it, if you're really doing that from an infinite banking perspective, but it is part of the deal, right? Like, and so you need to understand that if something happened to them and you wanted to kind of self-complete that plan, don't forget, if you have all your money in a policy and that life insurance is on somebody else and they pass away, right? That money all of a sudden becomes like tied up in their whole death situation, right? So you have to be able to go and get a death certificate for them to be able to get paid out on that. So make sure that you have a really good relationship with them, that it's a long-term thing, that you're going to be able to access that death certificate, and that it's not something that's going to become a problem for you should they wind up having a failure of health or having something catastrophic happen to them along the way, because that could put you in a bad situation. So that's the first thing. The second thing the second question, most frequently asked question that I get is, what if I want to save more money later? This might actually be the most common question I get, because it comes into play when we're talking about policy design, right? A lot of times people like to design policies with the mindset that, hey, what if I could design this so I could put more money in later, because I know I'm going to be able to contribute more, and I want to be able to make sure that I can, do that. If I know I can afford $10,000 for my premium this year, but I think in the next couple of years I'll be able to afford $15,000 or $20,000, they think they want to design the policy for that. Here's what I'm going to tell you. Always optimize conservatively for what you can do today. You can do what we call stacked policies. It's not hard to get more than one policy. As long as you have the ability to get insured for the amount of insurance that is required to get your policies, in force on you, and you qualify for that insurance, you can always do more policies. It's one of the challenges sometimes with the policy design and structure. You want to make sure that you're not designing it so you have so much insurance that if you want to put more insurance in later, that you don't qualify for another banking policy. So that's something to take into consideration as you kind of go through this. And that'll your age, your health, all that stuff will have an impact on that. So that's something to consider. But always remember, if you want to put more money in later, optimize this policy. I don't care if you're doing $2,000 a year, $10,000 a year, or $50,000 a year. It doesn't make a difference. Optimize what you're doing today for what you can afford out of your cash flow today, because once again, you just want to optimize this, because anything you do with allowing you to put more money in later is going to have an inefficiency from a cash perspective. And so you can always add another policy in later. So the next thing, question number 3, the third most frequently asked question is, how do the term riders work? If you understand how A properly designed whole life insurance policy works. It means you're using paid up additions, and when you use paid up additions, they become what you call a modified endowment contract if you use too many paid up additions. In order to avoid a MEC, what we have to do is we have to add a term rider to it to get the amount of insurance that you need, so you can get the cash accumulation in there that you want. Now, eventually that term rider will drop off. Once again, I get a lot of people asking, how do these term riders work? Well, depending on how you want to leverage the term rider and how the policy is designed, a lot of people think that you can convert the term riders very easily. In a lot of situations you can, in a lot of situations you can't. If you've built a policy to optimize based on this term rider being in there, you're banking on that term insurance being a part of the policy. So if you convert that term, you're now reducing the amount of insurance, which could potentially create a MEC situation for your contract. So you need to make sure that whatever you do, if you add a term rider, you want to make sure that if you plan on converting that in the first couple of years, especially, you want to make sure that you do have room built in, right? If you know you're going to do that. Otherwise, what I would do is I wouldn't even go that direction. I would say dial in your policy for how you want it, and then buy a separate term policy, a convertible term policy on the side to lock in your insurability, and then convert the convertible term policy in increments over the time as you know you want to add and stack other banking policies on top of what you already have. So the fourth question that I have, the fourth frequently asked question that I have is, what if I don't need insurance? It's funny, I actually had 2 conversations with people today about people who said, I don't have a wife, I don't have kids, I don't have a need for insurance. And honestly, that's why I thought I wasn't ever going to buy banking insurance, like this infinite banking concept, right? And they kind of walked me down this process. It was so funny. They both said the same thing, pretty much, where they both went down this path of discovery where they realized this is what it was, and it wasn't about the insurance. And they're like, what? I don't need insurance. Well, guess what? I got news for you. This is life insurance, right? So you have to qualify for it. There is going to be a cost to it. And with that cost, there is a certain inefficiency with the money for the first year or two, right? Like, you have to know that this is a long-term plan, and insurance is part of that long-term plan. Now, I don't know a person alive who doesn't want insurance, right? Like, this is the biggest thing. I'm going to argue with you. If you say you don't need insurance, I'm going to say that's fine. You don't need it. Guess what? I have a wife and 3 kids. I don't need it either. I want it. I want to take care of my family. I want to take care of making sure my kids get what I want them to have for a life. My wife has what I want her to have. And even if I didn't have those, I'd still want insurance because I'd want to be able to leave a legacy. I want to be able to leave an impact with my church. I want to be able to leave an impact in the communities and organizations that I want to support, right? Like, that, to me, life insurance is never a need conversation. It's always a want conversation. So I think it's important to take that into consideration when you're thinking about like the insurance component of the infinite banking strategy. It's a long-term deal. Like, you have to be thinking long-term. You have to be thinking legacy with it. And the short-term inefficiencies that come along with the insurance, and a lot of people like to look at it negatively, like I don't need it, so why would I pay for it? When you take the insurance out of it, it makes sense, and it's a long-term play, and the math works. But I'm telling you, really tap into the fact that you may not need it, but I promise you, you want it. So, frequently asked question number 5 is, what is the amount that I need to get started, right? So a lot of people come through YouTube and they talk to me about, I don't have $20,000 a year. I don't have the $100,000 or $10,000 a year that you're talking to me about, or that you're showing in your illustrations. So how much do I need? Can I even do this? And so my answer to you is, for the most part, you can start with probably $250 a month is like, in my opinion, a good number. I think the biggest thing isn't a matter of like, what's the minimum that you need to get started. I would start with not even talking about that though. I would start by talking about, what do you want to accomplish? What do you want this policy to do for you? And you need to align your expectations along with your goals, like, and your behavior along with your goals, right? So if you tell me you want to get into real estate and you want to use this policy as a way to save up and capitalize an account to put a down payment on a turnkey real estate investment property, and you're going to need $60,000, my question back to you isn't like what's the minimum that you need to do. When was the last time you talking about doing the minimum to get to where you wanted to go was the right decision, right? I would argue with you that it's not about doing the minimum. It's a matter of like figuring out where do you want to go, what do you need to do to get there, and how can you make that happen, right? So if you're telling me you want to get a car in 5 years, well, what do you need to save a year to make sure you're capitalizing that? If you tell me you want to buy your first rental property in 4 years, where are you now? What do you have for resources? What do you need to do to get there? And is what you're doing in alignment with your objectives, right? Like, stop thinking minimum and start thinking achieving your goals, designing the life that you love. Like, that to me is what this is all about. So thinking about the minimum is the wrong mindset. Now, I will take the next step and say, if for some reason you're new to this and you have no debt and you really don't have an objective yet and you're just looking to build an emergency account and applying the minimum to this instead of putting money into a bank account is what you're thinking of, well, then I would say, as long as you're like, let's say you're under 40 and you're healthy and whatever, I would say about $250 a month is where I would start to get going with this. So frequently asked question number 6 is, does it make sense to use qualified money like a 401k in the United States or RRSP in Canada? Does it make sense to use that qualified money to put into a policy? I'm not going to get into a lot of this. I've done a lot of videos on the topic of this, and this is one of those topics that would probably take me 40 minutes just on a video alone if I wanted to, or at least 20. But here's what I'll say to this. You got to be really careful when you're using money from a qualified plan going into a whole life policy. Not that it's a bad thing, but it's about, once again, expectation management. You got to manage the risks for taxes. You got to make sure that any distribution you take out of your qualified plan is that you understand what's coming along with that it doesn't bump you up into the next bracket. You understand the penalties that come along with it, and you understand all the ramifications, right? Because here's the bottom line. The way I look at it, I should say, is that it's not a matter of, should I use this money to go into my whole life policy? To me, it's two separate conversations. It's not like, do I take the money and put it in my whole life policy? The first conversation is a 401k or a qualified account the right place for my money, right? They're two separate conversations, two separate decisions. I don't think you should ever say, I'm just moving my money from my qualified account into a whole life policy, because it's apples and oranges, right? A qualified account is a completely different tax mechanism. It's a completely different risk mechanism. It's a completely different investment mechanism. Whereas a whole life policy is a savings mechanism. It's a savings alternative, not an investment alternative. So it's important to understand you can't just say, I'm going to take from this and put into that, and it's an apples to apples conversation, because it's not. So the first conversation is a qualified account the right place for my money? Do I want to be in business with the government, with the government at $30 trillion in debt, like the worst money manager in the history of the world? Do I want to be in business with with the worst money manager on the history of the face of the earth? Do I want to be in business with them? Do I think that taxes are going to go up? Do I trust the market volatility? All these different things that come into play that have the potential to strip your wealth away from you. You have to make the decision for you, first and foremost, independently of any life insurance conversation, any infinite banking conversation. You have to make the decision for you, is that place the best place for my money? If not, you should cash it out. You should do what's right for you. You should make the analyzed decision for you, what's good, and pay that penalty, pay the taxes, because remember, the taxes are going to be paid anyway. You're probably going to pay more later if what I think is going to happen, right? So yeah, you're going to have that 10% penalty, but there's an opportunity cost to not having access to that money, which I think you can more than make up for by paying that penalty and gaining control of your capital. Now you have control of your capital. The question is, what do you do with it? Where can you save it? Where can you store it? That's where I think, if you compare all the different assets, whole life comes into the equation. I think it's a really amazing alternative. It's a really amazing option for people, but I don't think it's wise to just say, I'm taking from here and putting into there, because it tells me you haven't gone through the whole process of thinking through what your objectives are, what you want your money to do for you, and then ultimately, where am I going to store that money to create my wealth. So frequently asked question number 7 is going to kind of be a piggyback on that, is whole life insurance a good investment? I've done a million videos on this, I feel like. Whole life insurance is not an investment at all. I just touched on it a little bit. It is a savings alternative. If you look at the difference between an investment and a savings alternative, it's just a function of risk. Investments can lose money. Savings vehicles cannot lose money. Whole life insurance is the equivalent of a savings vehicle. IUL is the equivalent of an investment alternative. Does it look like it has a little more upside? Sure it does, but an IUL is not going to outperform a whole life policy long term. By long term, I mean over a 20-year period, because of the fees and the charges and everything that they do inside of those mechanisms. An IUL policy cannot outperform the general fund long term. That's just the way it is. So that's an investment alternative, and you can risk loss with that. You could have the policy lapse. You could have it like self-implode based on fees and charges and all that stuff, and flat markets and so on and so forth. With a banking policy, with a whole life policy that we're talking about, it's a savings alternative. So you want to make sure whole life is a savings vehicle, not an investment vehicle. So when you come at it from that perspective, you look at it differently. Now you leverage the money in your whole life policy to invest in other assets like cash flow real estate, like cryptocurrency, like a business, like any kind of real estate, fix and flips, hard money lending, all that different stuff. All sorts of different ways that I've seen and helped people do this. But the bottom line is the investment itself is outside of the policy. The policy is just the storage vehicle, like your bank account. That's why we call it infinite banking. So frequently asked question number 8 is, why isn't everybody doing this, right? It seems too good to be true. Why isn't everybody doing this? Well, the answer to that is I don't know. Like I feel like it's just when I first started this channel, I got a lot of feedback where people didn't really like me. Like insurance agents didn't like me because I was just kind of preaching this thing that kind of cut into their commission, and then investment advisors didn't like me because I was talking about this asset that was totally contrarian to what they were knowing and educated about. And the bottom line is this strategy is easy to understand if you want to learn it. The reason you don't know about it probably is that it's people are doing this that are pretty sophisticated with what they do. They're the people that are into business, into real estate investing, into stuff like that. Like Robert Kiyosaki is one of those guys that just understands the power of this and leverages this strategy in his own life. I've done a couple videos on this. I've shown proof of the email that he sent talking about this strategy for himself personally, right? So that's an example of people get this, but I think the problem is, people don't have a long enough term mindset, like a long enough view of what they want to accomplish. And it's that old adage, if you don't plan for your future, you're going to live somebody else's plan. And this is just one of those areas you have to live intentionally into the future, and you have to plan with specific intent. And if you don't, then you're not going to be open to this. And if you do and you really think about it, that's when you're going to open your eyes to this opportunity. And if you surround yourself with people at higher levels, because this is not like a middle class thing to do. The only middle class people that are doing this are people that want to break through and hit the next barrier. Or break through the next barrier, I should say, and go from there. So that's why I think not everybody's doing this. I think a lot of people are doing this. If you're asking yourself that question, I think it's just because you're not hanging with the right people. The next question I get is, can we help people in the USA and Canada? And the answer is yes. I mean, we help people in Canada. We help people in the United States. You could see, if you look up my videos, we have some of the top rated videos for infinite banking, education, coaching in Canada. You can Google us, infinite banking concept Canada. We have like some of the top ranked stuff out there. Like we love helping Canadians. All you have to do is go to cashflowhacking.com, click on the Canadian tab. You can set up a conversation with one of our Canadian representatives. They're happy to help you out. And in the United States, obviously, we have a lot of people there that can help you out as well. Connect with one of our authorized agents, and they will walk you through a process, through a clarity call that will really help you out in probably more ways than you expect. So I'm going to leave it at that. I don't want it to be a sales pitch, but yes, we can help people out. So I left kind of one of my favorites for last. So frequently asked question number 10 is, can you pay off debt with infinite banking? And Here's the deal with the debt conversation with infinite banking. I am not a purist on this. There's a lot of people that say, yes, infinite banking is this amazing tool that you can use and create like what they call velocity banking to pay off debt. I'm not a big believer in utilizing pure infinite banking to pay off debt unless you have a front-loaded dump-in, but therein lies a caveat and a problem because of the fact that most people with a lot of toxic debt don't have access to capital to basically put into a policy to refinance their toxic debt in their policy. If you could do that, I think it's an amazing way to go. But the problem is if you have $20,000 in credit card debt, right, and you're telling me you want to put in $10,000 a year into a premium, your first couple of years, you're going to lose liquidity if you design that policy properly. You're going to lose liquidity, and that money has an opportunity cost. The money, if you did a 40-60 policy on a $10,000 premium, that means you're going to put $6,000 in cash and $4,000 is going to be to cover the insurance. Now, long term, that's a great thing, but short term, that's $4,000 that you're losing liquidity of that you could use to pay off some of that $20,000, right? That could reduce your toxic debt by an extra 20% in year one, right? Whereas you don't have that out of the gate. So what I would say, if you put the money in a policy, so what I would say is if you have a lump sum that you can put into the policy that you could refinance debt, that's fantastic. But the rest of it, I think you need to take that on a case-by-case situation. It can make sense sometimes, but it's certainly not the most short-term efficient way to go. My typical response to that is pay off your debt first and then start the policy. Get rid of the toxic debt first and then start your IBC policy. Or at least have a smaller IBC policy to build up your emergency account, because if you go from that perspective, I think you always need to be building an emergency account even before you've paid off all your debt, but don't do it to the level where you're putting all your money into that to make that happen, and then borrowing against it to pay off that debt. That's not the most efficient way to go. So if you have any questions about all this, go ahead. There's a link down below. That is the 10 most frequently asked questions that I get in regards to the infinite banking concept. And if you want, go down below. There's a clarity call link. You can set up a call with one of our agents. It is going to be probably one of the best half hours that you've ever spent on your personal finances. I think it's an extremely valuable thing that everybody would benefit from. So if you have any questions at all, reach out, make a comment. I engage with everything. Hit the subscribe button, click that bell, that way you get notified every time we launch a new video. Till next video, I hope you found value in this. Have a blessed, inspirational day. We'll talk soon. See ya.